You've got something in your portfolio that's been bleeding all year. Gold. Bitcoin.
Gold prices fell to a 7-month low today.
Shouldn't panic if it loses 50.
Meanwhile, the AI and chip names won't stop ripping, and you're feeling the pull to dump the protection and rotate into the winner. And that logic holds. Right up until everyone reaches it at the same time. Because when the whole market piles into the safe trade, safe is exactly what it stops being. So in this video, we're covering 3 things. The rotation, the crowd leaving protection to chase performance. The concentration, that performance stacked into a handful of names. And the transfer, the assets change hands, so someone ends up holding the top. Follow all 3 of them, and you'll know who's on the other side of your trade, because it's rarely who you think. Stay to the end for that last part. It's the signal that tells you the crowd is about to turn, the part that actually protects your money.
Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem.
Before we go further, you should know who I am. My name is Martin. I've watched investors make the same mistake for decades, selling protection right when they need it most. Now, I'm not on a trading desk, I don't run a fund, and I have nothing to sell you. What I do have is a memory. I watched this exact move play out in 2000, and again in 2008. Both times the crowd sold what protected it to chase what was already flying. Both times it felt like an obvious trade. That's the tell. It always feels obvious from the inside.
In the American economy is an economic train moving down a track that has no ending. And it picks up cargo and passengers as we go along, constantly moving more and more cargo and passengers along. And occasionally that train is going to get derailed.
So let's start with the rotation, because the numbers are genuinely staggering. Since April, roughly $20 billion has flooded into semiconductor ETFs. Over that same window, gold and Bitcoin ETFs bled around $12 billion out the door. On a single day, June 18th, one semiconductor fund pulled in $6.9 billion. $6.9 billion in one day. Meanwhile, the leveraged chip ETF is up approximately 440% year to date, and total ETF inflows for 2026 have already crossed $1 trillion, running 45% ahead of the previous record. This is not just institutions leading the charge. This is retail money moving in size like it never has before. And here is the part that should make the hair on your neck stand up. Late cycle behavior rarely feels late from the inside. Let me say that again so it lands. Late cycle behavior rarely feels late from the inside. The chip index has almost doubled since April, and when something moves like that, selling the boring asset to chase the rocket does not feel reckless. It feels smart. It feels like you are finally getting it. That feeling is the trap. So why is this rotation so much more dangerous than a normal one? That brings us to link 2, concentration. Semiconductor stocks now make up 19.7% of the entire S&P 500. In 2020, that number was about 5%, so the weight has quadrupled in 6 years. But here is the receipt that should stop you cold. At the absolute peak of the dot-com bubble in 2000, semiconductors were just over 8% of the index. We are now sitting at more than double the concentration of the most infamous tech bubble in modern history. One single industry now weighs more than the entire energy, materials, and utilities sectors combined. As Citadel Securities analyst Scott Rubner has noted, roughly 20 cents of every dollar in the S&P 500 is now riding on chips, and 40% of the whole index sits in just 10 companies. Think about the boat everyone is standing on. When one side of a boat holds a handful of passengers, it floats fine. But when every single person rushes to the same side because that side is winning, the boat does not reward them. It flips. And the machinery underneath makes it worse, because it is mechanical. As chips outperform, their index weight rises, which forces passive funds to buy more of them automatically, which pushes the price higher, which raises the weight again. That works beautifully on the way up. It works just as violently in reverse. Bank of America's own bubble risk indicator has the chip sector sitting at 0.91 out of 1. That is within a hair of a maximum reading. Now here is the story retail is telling itself to justify all this. They watched the Magnificent Seven shed $2.3 trillion in market cap in June alone, and they decided the smart move is to rotate out of the AI buyers and into the AI suppliers. Sell the shiny toy, buy the picks and shovels. But when an entire market piles into the safe infrastructure play, it stops being safe. It becomes the single most crowded trade on earth. Because I have to be honest with you about the other side, or I am a cheerleader instead of an analyst. The bulls have a real point here. Global semiconductor sales are projected to reach $1.5 trillion in 2026, a near doubling from the prior year. And unlike the dot-com era of eyeballs and clicks, these companies have genuine, exploding revenue. 𝗕𝗙𝗪𝗏, the strategist who has extensively tracked and popularized the term AI fatigue, is himself still bullish overall. That is a fair objection, and I am not going to spin it.
It turned into AI fatigue, and now it's AI fear. It's almost kind of AI derangement syndrome. I mean, people have kind of gone off the deep end about how this is going to create major job losses and all sorts of other dire predictions. I think these are all extremes. I think AI is a great tool. I think we're all going to be using the tool to make ourselves more productive. I see this as a positive.
But here is where the bulls are misreading the board. Real revenue does not save you from a bubble. Remember the story of Cisco? They had real revenue in 2002. Cisco was the picks and shovels of the internet, the essential hardware everyone had to own. It fell 90% from its peak, and more than 20 years later, it still had not reclaimed that price. And 𝗕𝗙𝗪𝗏 himself is describing the warning lights. Falling token prices hint at excess capacity. Cheaper Chinese open source models are threatening the whole spending story. Hazy returns on hundreds of billions in AI capex, with no clear payback. The revenue is real. The valuations are not sane. The 𝗕𝗪𝗏 ratio is now in the 99th percentile of everything in history. A level only surpassed once at the absolute peak of the dot-com bubble in 2000. The 2021 peak came close, and the 1929 peak, by contrast, was significantly lower. Which brings us to the deepest link, and the one that changes everything: transfer. We need to look past what the crowd is buying and figure out who is taking the other side of their trade. While retail investors dumped gold ETFs, central banks bought a net 244 tons of physical gold in the first quarter of 2026. That is the highest first quarter buying pace on record for central banks, according to the World Gold Council. And 89% of central bank reserve managers now expect global gold reserves to rise over the next 12 months, according to the World Gold Council's 2026 survey, a record level of consensus around gold accumulation. And then came the report that says it all. The ECB confirmed in June that gold now accounts for 27% of global central bank reserves, surpassing US Treasuries at 22%. Although the ECB itself noted that much of this shift reflects gold's sharp price appreciation, rather than structural reallocation alone. Think about the magnitude of that shift. At the exact moment retail is selling gold to buy chips, the most powerful financial institutions on earth just made gold their #1 reserve asset. This is the transfer. The hard assets are moving from the panicked hands of retail into the permanent hands of central banks. And it is not just gold. The crowd is dumping Bitcoin, down over 52% from its high. Right as the Fed ended quantitative tightening in December and US money supply is growing again, they are selling their inflation hedges precisely as the printer starts warming back up. So watch the full machine now. Retail sells protection, institutions buy protection, and institutions hand retail the overvalued AI stocks in exchange. Hedge funds have slashed their Magnificent Seven exposure to a 3-year low, with tech representing just 14.5% of total US hedge fund holdings, down 7 percentage points since January, according to Goldman Sachs. That is not retail versus institutions on the same side anymore. That is smart money distributing into retail strength. You are not the whale in this trade. You are the exit liquidity. And here is the tell, the one signal I promised you. In June, the S&P 500 fell nearly 3% twice, while smaller stocks actually rose. The concentration is starting to crack from the inside, and the leaders are the ones bleeding first. So, let me bring this home. Rotation, concentration, transfer. The rotation is retail selling gold and Bitcoin to chase a chip sector that ripped 69% in 2 months. The concentration is that same sector, swelling to 19.7% of the index, more than double the dot-com peak, propped up by mechanical passive buying that runs in reverse just as hard. And the transfer is the handoff underneath all of it, where central banks and hedge funds take your protection off your hands and pass you their overvalued hype at the very top. Every one of those links is firing at the same time. Not most of them, every single one. Here is the thing about every cycle that has ever ended. The assets meant to protect you get boring, they bleed, and they test your patience until you cannot stand holding them anymore. The shiny object goes parabolic and screams that you are a fool for not being in it. And the exact moment the crowd finally capitulates, sells its armor, and goes all in on the hype, that is the moment the trap snaps shut. You are standing in front of two paths right now. One path sells its protection to chase the top with everyone else. The other path does the boring, patient, uncomfortable thing that the smart money is doing quietly right now. One of those paths becomes the exit liquidity. The other one owns the assets that cannot be printed, cannot be diluted, and cannot be rigged when the music finally stops. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.